When you look at a price chart, what are you actually seeing? Most traders simply notice candles moving up and down. They focus on patterns and lines. But in reality, they are missing the most important piece of information on the entire chart: volume. Price acts as the advertisement, while volume represents the actual transaction behind it. It is like judging a restaurant only by its sign outside, without ever checking whether there are any customers inside. Welcome to the Com Lucro channel. In this video, I am going to show you how to read volume the right way. Not just what volume is, but what it truly means, why it matters, and how to use it to understand what is really happening behind every move. By the end of this video, every candle on your chart will tell a story, and volume will be the confirmation. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. So let us get into it and start with the basics. Every chart speaks two languages at the same time. Language number one is price. Price tells you what happened. Did the market move up, move down, or stay sideways? That's the headline, the news title. Language number two is volume. Volume tells you how much conviction was behind that move, how many traders participated, and how much money actually moved in that moment. That's the evidence, the confirmation. Think of it like an election. Price is the result, who won, but volume is the number of voters who actually showed up. If only 10 people voted, does the result really mean anything? But if 10 million people voted, that becomes a clear declaration. The same logic applies to the market. A big green candle on low volume looks suspicious, while a big green candle on high volume shows real conviction, something that truly matters. From now on, every time you look at a chart, do not just ask where price went. Also ask how much money stood behind that move. Now here is the single most important idea in this entire video. To read volume correctly, you only need one mental model. Just one. Effort versus result. In the market, effort is volume, how much energy and how much money is being used. Result is the candle, how far price actually moved. Think of it like pushing a car up a hill. Your foot on the gas pedal represents the effort, and how far the car moves represents the result. Case number one, you press the gas and the car moves easily. Big effort, big result, everything is aligned. On the chart, this appears as a big candle with high volume underneath. There are lots of buyers and strong conviction behind the move. It is real, like an entire stadium standing up to cheer. That is genuine excitement. Case number two. You slam the gas pedal. The engine roars and fuel is burning, but the car barely moves. There is something blocking the road. On the chart, this shows up as a small candle with massive volume underneath. This is what we call absorption. So what is actually happening? Buyers are pushing aggressively, but there is an invisible barrier. A large seller, smart money, is positioned there, quietly absorbing every single buy order. Think of a dam. Water keeps flowing in, but the dam holds everything back. Case number three. You barely touch the gas, but the car continues rolling uphill on its own. There is no resistance. The road is completely clear. On the chart, this looks like price moving up on low volume. This is known as no supply. It does not mean buyers are extremely strong. It simply means sellers are absent. There is no meaningful opposition. So the market does not need much effort to move, like walking on an empty road with nothing blocking your path. Now here is your cheat sheet. High volume with a big candle signals a healthy move. High volume with a small candle signals absorption, a potential warning sign. Low volume with price still moving signals no supply or no demand, meaning the other side is absent. Memorize these three combinations. They form the foundation of everything that comes next. Now let us apply the concept of effort versus result to specific candle patterns. This is volume spread analysis, also known as VSA. There are three patterns every trader should recognize. Pattern 1, starting volume. Imagine price is dropping aggressively. Red candle after red candle, and everyone is panicking and selling. Then suddenly, you notice something different. A tall red candle forms, and the volume underneath is extremely high, the highest in weeks. But here is the key detail. The candle does not close at the very bottom. It leaves a long wick below, with the close somewhere near the middle. So what actually happened? A participant with deep pockets absorbed everything that panicking sellers were throwing into the market. They did not stop the move with words. They stocked it with capital. High effort, but limited result. Price did not continue lower despite massive volume. That is absorption at the bottom, a potential reversal zone. Pattern 2. Buying climax. Now imagine the opposite scenario. Price has been trending upward for weeks. The news is positive, and everyone is feeling bullish. Retail traders start jumping in because they do not want to miss the move. Then a large green candle appears with extremely high volume, the highest on the entire chart. For most traders, this looks like strength. But here is the important shift in perspective. This is not aggressive buying. It is aggressive selling disguised as buying. Smart money uses that wave of retail buy orders to distribute their large positions. They are selling into demand, quietly, without immediately pushing price down. Think of a vendor in a crowded night market. The busiest moment is often when they are clearing out the last of their inventory. The moment you feel the urge to FOMO in at the top might be exactly when smart money is exiting the market. Pattern 3, no supply test. After an uptrend, price begins to pull back slightly. You start to question whether this is just a correction. Then you shift your focus to volume. A small red candle appears and the volume is very low. The market is essentially asking the question, does anyone want to sell here? And the low volume provides the answer. Not really. This is what we call a no supply test. Sellers are absent and the uptrend is likely to continue. It is like testing whether a fire is hot. You bring your hand close and it feels cool, which means it is safe to move forward. 3 patterns, 1 mental model, effort versus result. That alone is enough to interpret most of what volume is telling you on any chart. Now, before we go further, let me clarify the most common mistake in reading volume. And if you have been making this mistake, do not worry. Almost everyone does. The myth is simple. A green volume bar means buying, and a red volume bar means selling. That is not how it actually works. Here's the truth. Every single trade requires both a buyer and a seller, always. If you bought 100 shares, someone else sold you those same 100 shares. Volume measures the number of transactions, not which side is in control. The color of the volume bar simply follows the color of the candle. If the candle closes higher than it opened, the bar is green. If it closes lower, the bar is red. That is all it represents. It has nothing to do with identifying who is buying or who is selling. Think of a busy fish market early in the morning. The place is crowded and volume is high. But there are buyers and sellers everywhere at the same time. Busy simply means activity. To understand who is actually in control, you need to look at where the candle closes. So here is the rule. Do not focus on the color of the volume bar. Instead, focus on the size of the volume bar combined with where the candle closes. Size combined with close position, that is where the real story is revealed. Now let us move into one of the most powerful warning signals in volume analysis, volume divergence. When price and volume move together, the trend is considered healthy. If price is rising and volume is also rising, the move is strong. If price is falling and volume is decreasing, it suggests that the selling pressure is weakening. However, when price and volume begin to disagree, that becomes your early warning system. Imagine price continuing to make new highs. The chart looks strong, and everyone is celebrating the move. But at the same time, volume bars are getting smaller. Each new high is supported by less volume than the previous one. Think of the rocket. At launch, the fuel is full, and the rocket takes off with tremendous power. But as the fuel burns, the thrust begins to weaken. The rocket slows down, and eventually, it falls back. That is exactly what declining volume during an uptrend represents. The move is running out of fuel, and fewer traders are willing to support it. The same principle works in the opposite direction. If price is falling and volume is also decreasing, Sellers are becoming exhausted. Each downward move has less participation behind it. The selling pressure begins to dry up, which often signals that a bottom may be forming. Volume divergence acts as your early warning system. The market has not reversed yet, but it is already showing signs of fatigue. Now let us turn everything into a simple process that you can apply on any chart in any market starting today. I call this the 3-step volume check. Step 1 is to zoom out. Before focusing on individual candles, zoom out to the daily or weekly chart. Ask yourself a few key questions. Is volume increasing or decreasing? And are there any unusual volume spikes appearing? Step 2 is to zoom in to key levels. Identify the most important support and resistance areas on your chart. Then observe what happens as price reaches those levels. This is where you apply the concept of effort versus result. If price reaches resistance and volume spikes, but the candle remains small, that is absorption. The barrier is holding. If price breaks through resistance with a strong candle and high volume, that signals a genuine breakout. If price breaks resistance on low volume, be cautious. That kind of move is often a trap. Step 3 is to wait for confirmation. This is where most traders make mistakes. After a breakout occurs, wait for the next candle to form. If price pulls back, and that pullback happens on low volume, that is a no supply test. That becomes your confirmation. Having the patience to wait for one additional candle can save you from many losing trades. Let me show you how this looks in practice, step by step. Price is approaching resistance, and the context is clear. You zoom out, and volume has been steady up to this point as price touches resistance. Then volume spikes, but the candle is still small with a long upper wick, which is important to notice. High effort, small result. That is absorption, and it tells a story. The wall is strong in that area, so you do not buy into that move. Instead, you wait with patience and discipline. Price drops, and the reaction confirms the idea. You avoided a trap simply by reading what the market was showing. So think in 3 steps and keep it simple. First, zoom out. Then zoom in to key levels. Finally, wait for confirmation. That is your volume playbook in action, every single time. Now, before your next trade, take a moment to run through this quick checklist and stay consistent. 1. Is volume increasing or decreasing compared to recent bars? 2. Does the effort match the result? Big volume should mean big candles, and if not, someone is absorbing. 3. Are there any unusual volume spikes near key levels that stand out? 4. Is volume diverging from price? New highs on lower volume is a warning sign. 5. What does the next candle confirm after the move? Never act on one candle alone. Always wait for that extra confirmation. When you ask these 5 questions, you are no longer guessing. You are reading the market with clarity. You are seeing the proof behind every move as it unfolds. Because volume is not just another indicator on your chart. It plays a deeper role. Volume is the truth serum of the market, revealing what is really happening. Price can be pushed around, and price can be manipulated in the short term. But volume shows you where real money, real commitment, is actually stepping in. Please also remember that the mission of the Calm Lucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the Calm Lucro Trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.